lows of a couple of years ago, both gold and silver pretty much tracked along together. So both are basically doubles off of those lows. It's just that silver typically outperforms in a bull market, and it hasn't done that yet. I think that's about to change, or is in the process of changing now, where you're going to see silver outperform gold. They'll both do well. Gold is, going to 4,000 from 3,400 is a pretty good run, but silver going from say 37 to 75 is a lot bigger run. So I think that's what I think the next 3 to 6 months is going to look like.
Financial analyst David Hunter, recognized for his expertise in investment research and portfolio strategy, believes silver is poised to deliver superior returns compared to gold in the coming months. Hunter's analysis centers on the mathematical advantage silver holds in terms of potential returns. While a move in gold from $3,400 to $4,000 represents a notable advance, a corresponding rise in silver from $37 to $75 would constitute a much larger percentage gain. This dynamic underscores silver's potential to outperform its more expensive counterpart during the current bull market phase. Gold has already captured considerable attention this year, with its nearly 30% rally, prompting a growing number of analysts to set price targets around $4,000 per ounce. However, market sentiment remains divided, with not all financial institutions sharing the same bullish outlook on the yellow metal. Looking further ahead, some analysts project silver could reach $75 by the end of 2030, drawing support from historical patterns and sustained bullish market conditions. These projections are grounded in decades of market data that reveal telling patterns in the relationship between the two metals. Historical analysis of the gold-to-silver ratio provides compelling context for Hunter's expectations. Over the past 25 years, this ratio has averaged approximately 70, while the 50-year average sits in the low 50s. Crucially, historical data shows this ratio tends to decline sharply during the later stages of gold bull markets, a pattern that typically signals silver's superior performance during these periods. From a technical perspective, Hunter emphasizes that silver has recently broken out of a multi-year trading range and is now exhibiting strong technical behavior. He characterizes the metal as alive and well and ready to run, suggesting that the technical setup supports his bullish thesis for silver's near-term performance. The broader precious metals sector is showing encouraging signs across multiple indicators. Both gold and silver are currently trading above their rising 200-day moving averages, providing technical support for continued upward momentum. Additionally, mining indices have successfully broken out above multi-year resistance levels, while relative strength indicators are displaying positive divergences against broader market indices. Before we begin, subscribe, tap the bell, and share the video.
My 75 target on silver has been there for quite a while, and when I raised gold, I actually raised gold twice in the time that silver stayed at 75. So silver still got a long ways to go to get to its target, whereas gold has gotten, my original target was 3,000. I raised that to 3,400 maybe a year ago or last summer. I can't remember exactly, and then raised it to 4,000 in April. So, my belief is, and actually, if you step back, everybody thinks silver is disappointed, but from the lows of a couple of years ago, both gold and silver pretty much tracked along together. So both are basically doubles off of those lows. It's just that silver typically outperforms in a bull market, and it hasn't done that yet. I think that's about to change, or is in the process of changing now, where you're going to see silver outperform gold. They'll both do well. Gold is, going to 4,000 from 3,400 is a pretty good run, but silver going from say 37 to 75 is a lot bigger run. So I think that's what I think the next 3 to 6 months is going to look like. Silver is poor man's gold. So yes, there's when you get the retail on board and the institutions start looking, they'll say, gold looks more extended, so I'm going to start buying into silver because it will track gold or better. So it's somewhat that poor man's gold alternative, and it's obviously one's at 3,400 and the other's at 37, much more affordable to the retail investor. So it's partly that. It's obviously the tape as the momentum goes. People get more speculative, and silver is a more speculative metal. It's also that when you enter that stage where silver really is going, part of that is because there's a higher confidence that things are okay. Gold can play when there's trouble out there. Gold can be both an offensive and a defensive asset. And that's another thing people misunderstand. They only think of gold as a defensive asset, and obviously that's been proven wrong in recent years. But it does, when you've got a situation like the Middle East, it certainly supports gold. Interestingly, though, gold's been kind of waffling here for a little bit, the last week or more, at a time when you have heightened risks in the Middle East. So that's interesting, and that just shows you when something gets overbought or gets in favor too much, even the news can't drive it higher. Sometimes it just needs that pause. The pause can be pretty shallow, but while it's pausing, it kind of rebuilds its, the sentiment gets more negative. It rebuilds its ability to move. The wall worry allows it to move higher later on. So, I think gold's acting great. I'm not worried about this very short term pullback. Silver looks really good. Silver broke out from, at least a couple year period, longer than that probably, to 137 recently. So I think that one's alive and well and ready to run.
David Hunter has maintained consistent long-term price targets for the major gold mining exchange traded funds, setting his sights on $65 for the VanEck Gold Miners ETF, GDX, and $100 for the VanEck Junior Gold Miners ETF, GDXJ. These targets reflect his bullish outlook on the precious metals mining sector and suggest significant upside potential remains in the space. Recent market performance has brought GDX tantalizingly close to Hunter's target, with the ETF reaching approximately $55. This positions the fund just $10 away from his $65 objective, representing roughly an 18% gain from current levels. The proximity to his target suggests that Hunter's analysis may be proving prescient as the mining sector continues its upward trajectory. GDXJ presents a more compelling opportunity from a percentage gain perspective, currently trading approximately 35 to 40% below Hunter's $100 target. This substantial gap indicates that the Junior Miners ETF may offer greater upside potential for investors willing to embrace the typically higher volatility associated with smaller mining companies. Let's get back to the interview.
Sure, I think the miners are, as if my numbers are right on the metals, the miners have a lot of upside ahead, and they do look like they're coming out of very long bases in many cases and just beginning to move up. So I think there's big runs ahead in the miners, and this is just pre-bust. There's going to be even far bigger runs post-bust, and then a big correction during the bust. But we're just talking pre-bust. I've got a target on a long held target in the gold miners of 65 for GDX and 100 for GDXJ, and they're not that far away. I mean, GDXJ is still 35% away or whatever it is, maybe 40%. But GDX got up to 55. It's only $10 from my target that I've had for probably 5 years. So there's room there for those targets to be raised. I haven't done it yet, but I could. Silver miners, my SIL target is 75. Still a good ways away, but not that far. It was a lot farther away not that long ago. SILJ is currently 15-ish. And I have a 35 target, so that one's got a good distance to go. But even there, I think, the miner, that shows you what kind of upside I think we have this year from here. So I think miners will be certainly leaders in this, in terms of performance leaders in this last leg. They could keep going beyond the top in the indexes. People, I've made that comment over the years. People want to pinpoint it. It's not a precise thing. It doesn't have to happen that way. It's just, they have farther to go. They're later cycle, so it just stands to reason that you could have the indexes top out, say in September, and the metals, the miners top out 2 or 3 months later or a month later. So, but there's no rhyme or reason. There's no precise timing of that. They could top out They could have bigger runs and top out with the indexes. It's kind of a side comment that people take too seriously. It's just the likelihood is they could go beyond the index top. So all I'm saying is if the market tops, that doesn't mean everything tops at once. Some of the later cycle things like miners typically could top later. So I think when I call it a bust, it's something bigger. I think something bigger, at least financially bigger than 2008-9. And 2008-9 was the biggest financial crisis in our history. It was big. It caused all kinds of dislocation. So to say we're going to come back to back with something that might be even bigger it surprises me. I mean, I've been saying it for a while, but when I started seeing what could lead to this, I said, we know that typically in history, you don't get back to back things like that because people learn from the last cycle and don't make the same mistakes. But things are kind of falling into place and have been for years that lead me to believe that we can get something similar but worse than 2008-9. And the biggest reason for that is the leverage. One lesson we didn't learn in 2008-9, because a lot of what happened in 2008-9 was caused by leverage. We've doubled down on the leverage. We've got even higher leverage today, and leverage in terms of to the tune of 320, 330 trillion in global debt. That's far higher than it was in 2008-9. Leverage to the tune of quadrillions in notional value of derivatives. That's far higher than it was at any time in history, including 2008-9. We're way above.
Gold and silver continue to show strong upward momentum, with both metals approaching key breakout levels that signal further gains ahead. Gold's steady climb and silver's accelerating performance suggest a shifting dynamic where silver may begin to outperform. As both metals respond to growing economic uncertainty and shifting market cycles, their current trajectories indicate that further upside is likely, with silver offering the potential for sharper moves in the final stages of this bull run. Do you believe gold and silver are entering the strongest phase of their bull run? Let us know in the comments below. If you found this insight on gold and silver helpful, give it a thumbs up, share it with others who follow the markets, and thanks for watching.